We also have Nicolas, Economides, NYU Stern School of Business Economics professor. Professor, thank you so much for joining us today. We're just getting these headlines. We heard the latest from Brian Chung down in D.C. In terms of when you look at this statement, what sticks out to you in this release?
I think, the first point is, of course, the rates are not changing. The Fed is patient. The second point is that maybe they're going away from a more traditional model in which they looked at growth and inflation as the key variables to watch. And I think they need to explain to us what kind of model they have right now. I mean, the market would need some guidance.
Is this something that you think that the market wants to hear when you take a look at the reaction that we have seen in stocks since we got this release? We are trading slightly higher, but not maybe the big jump that some could have been expecting.
Well, patience was expected, and the steady interest rates were expected. So I don't think that we would see a big reaction in the market. But I think that the Fed should take into consideration not only the pressure, of course, from the financial markets to keep interest rates low and the pressure from the president to keep interest rates low, but also the potential problems that low interest rates might create in the economy. For example, we have had a housing bubble in the past that was created because of low interest rates. There is speculation in commodities because of low interest rates. These are stuff that we should be concerned about, or at least the Fed should be concerned about, and balance these considerations with other positive effects of low interest rates.
Tony, just looking at this release, the one thing that Brian pointed out to us was the fact that the Fed did lower their interest on excess reserves by 5 basis points. Would you say, in your view, that this was just simply for the purpose of managing rates, like Brian was telling us?
Yeah, it's basically a plumbing issue. It has to do with how the Fed ensures that the actual effective rate stays below the top of its target. And so it has to do with a lot of technicalities around the way agencies are not allowed to actually hold reserves at the Fed. And so this basically ensures that loans to agencies are going to stay below a certain level and stay within the range.
Do you think at a certain point the Fed would revisit the corridor policy that it's had since the crisis, if only because I think cutting the IOER while leaving rates unchanged, look, everybody can do some reading comprehension here, but at a certain level it does create some confusion, I think, among some investors about exactly what is happening with Fed policy. But then again, they might argue that there are technical reasons that you would like to have 2 separate rates. At this point, basically 3 separate rates for
right, exactly.
policy.
Yeah, I think that eliminating the corridor wouldn't really change the fundamental problem, which is that you can go above the top end of the range. Mm-hmm. So you could, for example, get rid of the reverse repo rate, which is the bottom end of the corridor, as an official component of the corridor, but you still have the problem where the effective rate could go above the excess reserve rate due to the way the mechanics work with the agencies. So I'm not sure that would really solve that illusion, if you will. Yeah. So I don't think that they would address that in the short term, and I haven't heard anything about that.
Professor Economides, just to give you a last word here, do you think that we need to get used to living in a world right now of lower interest rates?
Yeah, we definitely are living in a world of low interest rates. What the Fed really should tell us is not what we know, that in fact we do live in that world, but the model that they're going to be using. The financial markets, and especially the fixed income markets, care a lot about these interest rates, right? So we need to know the model that the Fed is going to be using from now on, so that we know what to expect in 3 months, in 6 months, at the end of the year, and so on. So we need that. I think that would be the most important question in the press conference.
All right, Professor Economides, thanks so much for joining us today.